Wednesday, December 28th, 2022, Maneco 64, home of alternative economics and contrarian views. So I've said this a few times in the last couple of months that the gilt market was not out of the woods, and things don't look very good this morning in the gilt market. We're going to look as well at the government and whether it's guaranteed the bankers, again, a bailout. And why do I say that? Well, we're going to look at an article that just came out today in the FT about mortgages, banks, and the government. Before I start, though, I'd like to thank my affiliates. And yes, in this world of inflation, in this world of uncertainty, I personally continue to stack gold and silver outside the system. So my affiliate in the UK is Gold Investments. All the details are below in the description. If you're interested in buying gold or silver for the first time, or if you already buy gold and silver, Gold Investments has been in business for 40 years, and it's a family-run business. In North America, I've recently affiliated myself with Miles Franklin and also with ITM Trading. So all the details for those are below in the description. So back in November, after the autumn budget by the Chancellor of the Exchequer, Jeremy Hunt, people found that within that budget, within the small print, or if you care to read the whole thing, they came out and said that they were going to help people on universal credit with their mortgages, not the principal, but interest only. It says here, from spring 2023, if you're struggling to pay your mortgage and getting universal credit, you'll be able to apply for support on mortgage interest. A loan that helps with interest payments. Yes, a loan from the government, which will probably be backed by us, of course, if they fail to pay this. The taxpayer always pays in the end. After 3 months instead of 9. You can also apply if you're working. And at the time, I remember Martin Lewis, who's supposed to be a money-saving expert here in the UK, he said that he was involved with the government and the big banks to try to do something, not just about the people on universal credit, but the whole housing market. So this morning, I wasn't surprised to see this story that's just come out in the FT. UK banks to ease pressure on mortgage holders as late payments set to surge. Some measures could include switching borrowers to interest-only deals. And you see why I think the government has told the bankers in confidence that not to worry, if something happens, we'll be there. The government to help you guys out. Again, it's going to be, in my opinion, another bailout of the banks and another bailout of people who have leveraged themselves to buy their homes. And it's not surprising because it looks like Jeremy Hunt, well, it doesn't look like it, but Jeremy Hunt and his wife, they run a buy-to-let business. And it does seem to be highly leveraged, as you can see by these companies' house data here, Maripon Properties. But let's get back to the FT article and why I think the government is right behind these banks and the big banks in the UK. And why is the property market so important? Well, it's the only business that is still growing in the UK. Our industry, manufacturing, has been hollowed out basically, and we are borrow and spend economy, unfortunately. Yeah, and the City of London is a big part of that because it provides the credit. So it says here, some of the UK's largest banks have agreed to measures with the government to help struggling borrowers as they brace for a surge in late mortgage payments. So why would the government have to be involved in this? it's supposed to be a private sector activity, banking and mortgages. Well, I think it's because the government had to tell the banks, you do this, don't worry, we'll be right behind you. It says here, the so-called forbearance measures, which were used during the '08 financial crisis, are an attempt by banks, including HSBC, Barclays, Lloyds Banking Group, and NatWest, to avoid repossessions and more pain for borrowers on top of soaring inflation and high energy bills. So how is this going to help inflation? I don't know. It's actually going to make it worse because it's going to keep people going. They're going to keep spending and borrowing. What's the solution? Well, the solution is to let the free market take its course, which they haven't done for, well, since '08 when they bailed everyone out, and it looks like they're doing it again. So I'm not going to go through this whole article. I'm going to put a link to it below in the description under archive.ph. So if you don't subscribe to the FT, you'll be able to read it. But it's interesting that at the end here, this is what they say. And after this, we'll look at the gilt market. The Bank of England increased rates again this month to 3.5%, although some brokers argued that further expected rate increases had already been priced into the gilt markets. Some brokers predicted that banks would struggle to pass on significant further rate rises given the weakening housing market. Well, there was a weak housing market back in the late 80s, early 90s, and interest rates, mortgage rates got up to 15%. Demand for property has already slowed, so I expect the lenders will do more to attract borrowers next year, said Aaron Strutt, a broker at Trinity Financial. And this is what he says: we are already starting to see mortgage rates come down, but they're still much higher than they were. To Mr. Strutt, I would say that mortgage rates might have come down a little bit after the meltdown of late September, October, but they're going back up because gilt yields are going back up, and that's what we're going to look at today. So yeah, the markets were closed here on Monday and Tuesday, so we're back to work finally in the UK, as if we needed a lot of breaks in the current economic climate, I would say. But anyway, I've got the 30-year gilt yield here, up 14 basis points this morning. Yes, it's catching up a little bit with what Treasuries did yesterday, but it's back above 4%, which is quite significant. And yes, we did get above 5% during the meltdown in September, October. But yes, it's at 4.05, and you can see the chart here of the 30-year gilt yield. Just have a look here. It got up above 5%, as I said, back in September, October, and then it dropped almost back to 3%, just below 320, and now we're back above 4. And for the UK, the key rate really for mortgages is the two-year yield, and that as well got up to like 4.8 during the meltdown in earlier this year, and then it dropped below 3%, and now it's back up to 3.7. Today, the two-year gilt yield is up 8 basis points, which is quite a big move for a short maturity. The 10-year today is up 14 at 377. And if we look at the chart of the 10-year as well, as you can see, we got up to like almost 4.6 during the crisis, got back to just 3%, and now we're moving back up towards 4%. So I don't think the crisis is over. The sovereign debt crisis for the UK is over, and it's going to spread to all the major countries as well. The US, the EU, Italy, rates are going up there, and that's going to impact mortgage rates. That's going to impact the property market in the UK. Unfortunately, what's going to happen, in my opinion, is that we, the people who have been careful, who have saved, who have paid off our debts, who don't have mortgages, we're going to be paying for this. Also, the taxpayer who's supposed to be getting help, they're going to pay the highest taxes in 70 years. They're going to pay through more inflation because that's the only thing they know how to do, is to keep inflating the housing bubble and the economy. And yes, we'll have to see what the Bank of England does as well, but I'm sure the government is going to be right behind the bankers, the holders of big mortgages out there. They're going to try to bail them out as long as possible, because if the housing market collapses, the whole economy is going to be even worse than what it is now. So, and that's why at the beginning of this video, I talked about my affiliates, because in this environment, I think it's more important than ever to have a little bit of monetary insurance outside the system. And by that, I mean gold and silver. So with that, let's quickly look at where the markets are this morning. I'm a little later this morning. It's almost 9 a.m. So we've got spot gold at 1804. It's down about $9. The high's been 1815 and the low 1803. So silver is down 1.4% at 2370. The low's been 69, so we're right near the lows here. We're down 33 cents. The Dow futures is up 68. NASDAQ 100 futures up 12. And S&P 500 is up 6 points. To the currencies, sterling is down slightly at 120.21. Euro is virtually unchanged at 106.35. The dollar is up 0.5% versus the yen at 134.07. The dollar is up slightly versus the yuan at 697.50. Let's check the ruble or the dollar. Yeah, the dollar has gone up quite a bit against the ruble. We're back above 70 right now at 71. We had been around 60 for months. So why has the ruble dropped? Some of you think the ruble has gone up. No, it's the dollar that's gone up. I think it could be the Russian authorities are allowing the ruble to drop, because a lower ruble means they get more for their oil sales. And if their oil sales are capped, and the fact that they're also limiting production now, it makes their ruble receipts bigger. And also maybe they're getting less foreign reserves, and that's why the ruble's gone down like this. But it's still relatively strong, considering we went up to almost 140 right after the crisis started in February this year. So let's quickly look at the other rates here. Aussie dollar is up 0.5% versus the dollar, 67.62. The dollar is up 0.1 versus the Canadian dollar, 135.34. And the Kiwi dollar is up 0.5% at 63.03. To the general commodities, we got platinum trading down $6, around 1,020. We got WTI crude oil down 1% at 78.79. Brent crude is down 0.8 at 84.04. And high-grade copper is up 1/3 at 385. US nat gas is down 5.6% at 484. We know what the UK gilt market is doing, so we'll quickly look at the US Treasury market, see what that's doing this morning. Well, the 10-year yield is down about 3 basis points at 383. So with that, I wish you all a great day. Take care. Bye.